Hello and welcome to the Mutual Fund Show. It's Wednesday, 12:30 p.m. Your appointment with us on BloombergQuint to talk about mutual funds, topics pertaining to mutual funds, and try and figure out where is it that people could invest. Every week we pick out a theme. This week's theme is geographical diversification. Now, what are we trying to say out here? Just look at this compilation of data. Are you missing out on certain rallies? Now, what we are trying to show out here are 3 or 4 names which are not traded in the Indian markets. The last 10 years, from 2008 until 2017, this is still date, stocks like Amazon have given returns of close to 1300% in the last 10 years. That's a large company, arguably one of the largest companies, giving 1300% returns, 13x returns essentially. Tesla, even better. Companies like Apple, and we all know the kind of story that Apple has been, that has given amazing returns. Something that our guest holds in his portfolio, Alphabet Inc., which is Google, has given exceptional returns as well. The question mark is that if you are invested only in Indian stocks and only in Indian mutual funds, do you miss out on the rally that happens in global companies? And that's the question that we'll pose to both our experts today. Later on in the show, Rohit Shah, founder and CEO of Getting You Rich, will be joining in to talk about some certain specific schemes. But our special guest on the show today, well, needs no introduction. He runs the PPFAS, as it is popularly known, but Parag Parekh Financial Advisory Services Mutual Fund. Rajeev Thakkar, Chief Investment Officer and Director of the fund, joins me right now on the show. Rajeev, so good having you. Thanks so much for joining in.
Pleasure being here.
There is a standard disclaimer that I need to give out here that I personally am invested in the PPFAS mutual fund scheme as well. They have one scheme and I've been an investor with them for the last couple of years, at least, if not more. Rajeev, thank you so much for joining us today. Now, typically a lot of people who are watching this show are first timers. They are just starting to invest in funds and they'll say that, boss, abhi to investment chalu bhi nahi kiya hai. Why are you telling us to go out and invest in other funds which invest in global geographies, etc.? Is it that difficult?
So, that's a very valid question, Niraj. A lot of people have this question that when we are starting, we should keep things simple. Why go global, etc. I would argue in a contrary manner. I would say for the first timer, this would be the best vehicle to start with. And the reason I'll say is this, that more than the opportunities that you highlighted that are there globally, I would say that different geographies have differently timed market cycles. So for example, in India, 1992 to 2003, we had a 11-year period where markets were negative. So Harshad Mehta peak was 4,200 for Sensex, and March of 2003, we were at a Sensex of 2850. After 11 years, we were not even breaking even. Similar has been situation in the US market, 2000 to 2010. Japan has had a long bear market. So the biggest fear of a first-time equity investor is volatility and long periods of either stagnant returns or negative returns. When you have some geographical diversification, it mitigates some of those risks potentially. So I would say it is in fact suitable even for newer investors.
So you are trying to say that all markets don't move in tandem, yes. And therefore if you have a fund which invests in markets across the globe, there is actually diversification which may mitigate your risks.
Yes, that's precisely my point.
Okay. Now for a lot of viewers who might not quite understand this concept of how risk could be mitigated by investing in funds within various geographies, Jayesh Khilnani has compiled an interesting set of data. Let's hear out what he has to say.
Thank you, Niraj. So let's have a look at how geographical diversification would have helped rather than an investment only in India. Starting off in 2013, we can see that most of the developed markets performed much better than India. India with only 7% gains, and the US and the UK gave about 26 and 14% each. Well, in 2014, the tables turned, where India was one of the best performing markets, with China gaining as much as 50%. Going into 2015, which was a mixed year for equities, India once again did not perform as well as its global peers. The same story continued in 2016 as well, where once again the developed markets significantly outperformed India. So all in all, to conclude, an investor who would have diversified across geographies would definitely be better off than someone who would have invested only in Indian equities. Back to you.
Okay, so that of course gives you an indication of how if you indeed invest in separate markets at different points of time and not invested in just one market, you probably would have made money. But that's a thing that ace investors do. How should a retail investor approach such a phenomenon? Our answer is simple: by investing in mutual funds which invest in companies within various geographies. Now, Rajeev, if you are at a liberty, talk to us about how you carry out this process. How do you choose companies? I mean, do you invest companies only in a limited geography? I know by virtue of having studied your fund for the last 2 years that you have investments, or probably did have investments in Alphabet, which is Google. You probably had investments in IBM. I mean, how do you go about choosing these companies? What would an investor gain if he invests in a scheme like yours? By the way, is yours the only scheme in India which allows investors to do this? Any thoughts on that?
Sure. So there are a limited number of schemes which invest in global stocks directly. The more prevalent manner is where you have feeder funds, funds which collect money domestically, and the entire money is invested in some overseas mutual fund scheme.
Right.
How do we go about selecting geographies and companies to invest in? So for the moment, although our mandate is global, we can invest in any country, our restriction is right now to North America and Western Europe.
Okay.
And the reasoning is simple. We are going to geographies which have English language reporting, number one. Number two, we are going to countries where there is a history of protecting minority shareholder rights, political systems are stable, courts of law function well. So we are not going into exotic countries, exotic geographies. Also, the companies that we select are global multinationals, essentially to take benefit of a global diversification rather than very niche companies or very small companies. We are selecting companies which can be easily tracked from anywhere in the globe, and the products and services of the company should be very familiar to us and to our end investors as well.
Right. How do you zero down upon some large investments? I believe Alphabet would have been one of your large investments. Is this the same method that any other normal fund manager would follow for Indian stocks? You go via those principles and you choose a company that you will invest into?
Sure. So the criteria remains the same whether we are looking at an Indian stock or a global stock. Firstly, we look at the management quality, meaning the promoters and the managers should have a history of not cheating minority shareholders or not doing minority shareholder unfriendly actions. Also, they should have competence in running their business, meaning they should have a proven track record of generating high return on capital, return on equity, and of scaling the business. Leverage should be controlled. It should not be a very leveraged business. So once those basic filters are in place, then we dig deeper. Is this a business we can understand, where we have some visibility 5 years out? Are we confident of the prevalent valuations? Then we would go and execute the purchase.
A lot of people will say that monitoring companies which operate in one geography is difficult enough. How would a fund manager with his team be able to monitor companies in so many countries? Is that a difficult task, or are you limiting your hemisphere to certain large companies and therefore it's easier? You know what a Google will probably do. You know that the Google company will stay 5 years down the line as well. So how do any of other fund managers also kind of approach this problem?
Sure. So I think today, whether we like it or not, most research or logically most research should be done on sectoral lines rather than on geographical lines. So let's take an example of a fund which is only focused in India, and if that fund is tracking the IT space, let's say Infosys, TCS, Wipro, now that analyst will anyway look at a Cognizant, what Cognizant is doing, Accenture is doing, IBM is doing, because they are operating in that space. If someone is looking at the pharma space, if someone is tracking Sun Pharma, Aurobindo or Dr. Reddy's, people will anyway be tracking what is happening to a Teva or a Mylan. So essentially today, research is structured on sectoral lines rather than geographic lines. And when we research sectorally, we are able to identify opportunities in that sector irrespective of the country of listing.
Okay. Would this by nature become a defensive fund, Rajeev? The reason I'm asking is, so I'm taking your fund as an example, the Parag Parikh Long-Term Value Fund, and correct me if I'm wrong here, but the 3-year CAGR for the fund is about 13.6%. Is that correct?
Yeah, that would be the number.
Yeah, about that. And the CAGR since inception in 2013 is a healthy about 19-20%.
Yes.
So the CAGR since inception is really impressive. The last 3 years, you've been about 13.5, 14 odd percent.
Yes.
That's not top quartile.
Yes.
That's probably mid quartile. Is it the nature of the fund that you don't want to invest in high beta, and therefore while the returns will not be that great, your downsides will be protected as well? Should such investors approach such a fund?
So the point that I mentioned about lowering the volatility, obviously that comes by averaging the performance of the market which is performing best versus combined with a market which has not done that well. So in our own history of about 4.5 years since the scheme launched, we have had a phase of extreme pessimism in India pre-election. Then we had euphoria when a government was formed with a clear majority and business friendly nature. Then we had a tapering off of that enthusiasm. We had a very flat market, demonetization worries, big correction. Then again last 6 months have been extremely good for the Indian markets. So in a period where the Indian market is on a roll, this scheme will deliver returns which are lower than the Indian market.
Right.
At the same time, in a period where Indian market is not on a tear or where it is flattish or downwards, this scheme performance will look absolutely off the charts. So we are not trying to say that this will beat the Indian markets all the time.
What's the benchmark for a fund like this?
So our mandate is minimum 65 in Indian equities going up to 100 and 0 to 35 in overseas stocks.
Okay.
So given that the overseas component keeps fluctuating, we have benchmarked this to Nifty 500.
Okay.
And again, that is an opportunity set for the investors. Nifty 500 is a thing they can invest in without investing in the fund. So we are comparing performance with that.
Okay. Is this last two questions, Rajeev? One is, a lot of people will believe that if I'm investing in a fund which invests in global companies, what about exchange rate fluctuations, and will that hamper my returns?
Sure. So what we are trying to deliver is, we are trying to deliver rupee returns. We are not trying to benchmark it to dollar returns or things like that. So bulk of the exchange rate risk that is there is hedged out by using currency futures. What this does is, whether rupee goes up or down, about 80% of that exposure is hedged using exchange derivatives, which generates an additional return of, in the current market, about 4.5 to 5%. It's not a cost, it's an additional return to the fund. At the same time, eliminating the volatility.
Okay. And would this be a good time for people to invest in funds which are investing across the globe, also because of the fact that our Indian markets are trading close to life highs? I mean, barring the last couple of days correction, we are pretty much at life highs, which, well, even the global markets are.
Yes, true.
But if indeed there is a correction that you don't know what the beta nature would be, you probably understand that as well. So that's a final question from my end to you. Funds like yours, that is you and a few other funds which invest in global companies, is this a good time to invest in such a fund? Or would you believe that a balanced fund, for example, into any of the other pure play Indian funds would also help in mitigating the equity market risk in a big way?
Sure. So a balanced fund does it in a different way.
Yes.
It is Indian equity, let's say 65% plus fixed income.
Yes.
So this will not protect against a global equity downturn.
Right.
So the remaining portion is also equity.
Right.
So a balanced fund would have a greater downside protection in that sense compared to our fund. Our fund mitigates the individual market risk of one country stocks not
Sure.
doing that well. And as to whether this is the right time for a global fund, a fund which diversifies essentially admits that we don't know the timing question. It's an admission on our part. If we knew, for example, that global markets are going to do well, Indian markets are not going to do well, we would go 100% global.
Sure.
Why would you diversify? Again, if we knew Indian markets are going to do well, we would be 100% here. We are trying to balance it, saying we are not taking market timing decisions.
What's the last global stock you bought?
Facebook.
You bought Facebook. Did you buy Tesla?
No, so some of the fancied stocks are not there. We don't know how to value them.
Okay.
So Netflix, Amazon, Tesla, you can't value it on a conventional earnings basis or cash flow basis. We own Facebook, Google, and Apple. These are
You own
stocks.
Apple as well.
Yes,
You
these are
still own
stocks.
IBM?
We have a small position there. Yes,
But your largest 3 foreign holdings would be these.
largest would be Google, Alphabet.
Alphabet. Okay, one last question. Are you at a liberty to say what's your amongst the largest sectoral holdings in the Indian markets? If not the names, the sectors?
Yeah, so our portfolio is publicly disclosed. There's no secrecy as far as that. So I think financials would be there in terms of HDFC Bank plus a proxy to Bajaj Finserv through Bajaj Holdings. Auto would be again there.
Okay, fair call. Rajeev, really appreciate you taking the time out and joining us and giving us a perspective on how geographical diversification would actually help even first timers. Keep that in mind, viewers. Rajeev is saying that you don't have to be a SOV investor in order to invest in a fund like this. They are doing the hard work, they are doing the heavy lifting. All you need to know is that if you want geographical diversification, don't just want India exposure, then there are options like the PPFAS fund which are available for investors. Rajeev, much appreciate you taking the time out. Thanks so much for being with us today.
Thank you, Niraj, for the opportunity.
Okay, so that's of course the PPFAS view on geographical diversification. I just want to bring back one key slide which I wanted to talk about, and this is just re-establishing the fact that if you are indeed missing out on a rally, if you think you are missing out on a rally in some of the global names, the likes of Tesla or Amazon or Facebook or Google for that matter, or an Apple, then funds like these, there is an option available for an Indian investor to invest into funds in the Indian currency and still take advantage of investing in companies like this. And that's the conversation that now we'll have with Rohit Shah. He's the founder and CEO of Getting You Rich. Rohit, thanks so much for joining in today. Really appreciate you taking the time out. This is the concept of the show today, that Indian investors have the option of investing in funds which invest in global companies. Right. How many options are available if you have gone through this topic?
Yeah, sure. The good news is there are quite a few. As an investor, you could just do your same regular SIPs and invest into those funds which act as a feeder fund. So they take money from you and they invest into securities in US, so they invest into mutual funds abroad. So that's one option.
That's one option. Okay. What are the funds which do this? Any idea?
So I think most of the leading mutual fund companies, Franklin, ICICI Prudential, Motilal, all of them have these options available.
Okay, so that is one option.
Yeah. Then as a retail investors, there are a lot of brokerages and agencies. They specialize in getting you an open a brokerage account, and you could transfer the money and you can deal with them. One of the leading brokerage, ICICI Direct, also had that option earlier. The mutual fund option is something that we would normally recommend. The whole idea is that it keeps your financial life uncomplicated. So you don't have to kind of search around the data. Yeah. So you just do your regular SIPs and you also get the international exposure.
Okay, very interesting though. And it's okay to have different views, but sure. Rajeev was saying that for a first time investor as well, it's great to invest in a fund which is diversified into different geographies because you mitigate the risks. I see in your views that you believe that it's important for investors to first invest adequately in the domestic market. Why so?
So let's take a step back. Where we come from is the thinking all about asset allocation, because we all believe, and there's a lot of data available in the public domain about how asset allocation drives your overall return. And when you look at the asset allocation, you give adequate exposure to each of the asset class, and then you try to diversify within that. And within that, when you look at a country like India, with the kind of growth that you expect for next couple of years, it doesn't really make sense for you to look at like a 9, 10, 11% kind of a return, unless you are like a sizable portfolio and you really need to de-risk.
True. Okay. Okay. So that's a valid point. So viewers, there's a difference of opinion, but you can choose to do on the basis of, or what you want to do on the basis of what the comments have come in. Feel free to post in your questions as well, and we'll get them answered as well from our financial advisors. There are 2 or 3 funds which have done reasonably well from amongst this theme of geographical diversification.
Right.
Let's take it from a perspective of somebody who's got some investment in mutual funds
Sure.
and now wants to explore, which means that
Sure.
this is a good option for that.
Sure.
Now there are funds that we've spoken about: Franklin India, Feeder, Franklin US Opportunities.
Right.
There is the Motilal Oswal Most Shares Nasdaq 100 ETF.
Right.
And there's a Franklin Templeton Franklin Asian Equities Fund.
Correct.
Have you looked at these funds? Do you like
Yes.
any of these?
Yes.
There's
Yes.
also Parag Parikh Financial Advisory Services, which invest
Correct.
in this fashion. Have you looked at any of these funds?
Correct, correct. So these are all part of our regular portfolios that suitably gets advised. And some of these funds that we have mentioned, the reason why we like them, the performance is very consistent. And if you really look at an SIP based CAGR for last 5 years, these are like almost touching double digit with about 11%.
But 11% is not high. I mean, people have earned more than that in Indian funds any which ways.
And that's the trick. And that's the trick, Niraj, when you're investing into the international equity funds, our expectations on the returns have to be moderate. Because they're going to mirror the respective economies. And it's the India that you really look at when you want to really look at a double digit in a very high number.
But there is also a Most Shares Nasdaq 100 ETF
Correct.
which has gone up 18%. Have you
Correct.
looked at this fund?
Yes, yes, and I think that's more of an exception. With an 18% CAGR, I think that fund is doing very well. And ETF as a concept, and I think with the Motilal's experience, I think this stands out. But I would take it more of as an exception rather than rule. Because a lot of funds that we have seen, the Asian fund, the European funds, they languish, between like 8 to 11%, and the tax treatment is also not favorable. So you really have to kind of ideally wait for 3 years to get less of pinch on the tax. So it's much more patient journey.
So you would recommend that for people who are starting off,
Right.
Why invest in funds which are giving 10, 11%?
Yeah.
Indian mutual fund schemes are safe, and therefore
Yeah.
start an SIP in those funds.
That's right.
But
that's
if
right.
you have a sizable mutual fund or an equity portfolio,
Correct.
then maybe you could look at these funds, but the return expectation should be lower.
Correct. And when you have a sizable return, when you have a sizable portfolio, the current situation in the Indian market may make you uncomfortable with the valuations of Nifty at 24 plus.
Sure.
And that's where the right strategy for you is to look at an international diversification.
Okay, my last question to you on this
Sure.
show. Let's talk about it from a perspective of somebody who's got some investment in the mutual funds and is convinced that he wants geographical diversification.
Sure.
I may want exposure to a Tesla or a
Sure.
Facebook and so on and so forth.
Sure.
What is one good option available for an Indian investor out of the 4 or 5 or 6 existing?
I would simply say the fund of fund via the leading Indian mutual fund option.
Okay.
That's the least troublesome option. It makes your financial life easy. Keep doing SIPs, just follow them.
So how does one do this? Any of the leading houses have this scheme?
Yes.
Okay.
That's
so
right.
ICICI, HDFC, Birla, all of these houses would have
Yeah.
a fund of fund options.
Yeah, correct. Most of them have that. Birla has it, ICICI has it, Franklin has it, Motilal does it via the ETF way. So you can definitely go through any of these.
So ask your financial advisor for a
That's
fund of
right.
fund option,
That's
which
right.
invests into funds in the global markets, and you
That's
get
right.
exposure to the global equities.
That's right.
That's the route that you would recommend.
That's the.
But
route.
for somebody who's got some exposure to Indian equities anyways.
That's right. That's right.
Okay, great. Thank you so much for taking the time out and being with us today.
Sure.
And viewers, thanks for tuning in. If you have any questions, as we've stated, please feel free to post them. Even after the show, we request our guests to take time out over the course of the next 2 or 3 days and do respond to your questions as well, as and when they do manage to find the time. Thanks so much for tuning in to the Mutual Fund Show.